Okay, now let's move on to this particular question. Park acquired 75% of the issued share capital of SAM on 1st January 2016. So this company, the Park, acquired 75% of the issued share capital of SAM on 1st January 2016 for 9.5 million. Okay, so this is $9.5 million. Additionally, Park invested 1.2 million in SAM's 5% loan notes at par value. An extract of the financial statements of Park and SAM as at 31st March 2016 is presented below. So now you are given this financial statements is for 31st March 2016. Okay, so this is 31st March 2016, the financial statements, and P acquired SAM on 1st January 2016. Okay, so which means their financial period will end on 31st March 2016, and it will start from, if you take the financial period 1st April 2015 till 31st March 2016. Okay, so this is the financial period, a 12 months period. In between, P acquired is on 1st January 2016. So therefore, from the acquisition date to the reporting date, how many months? January to March, only 3 months. Okay, so if you take the period, okay, so this is 1st April 2015 to 31st March 2016. 31st March 2016. So in between, on 1st, this is the acquisition date, 1st January 2016, the company was acquired. So this is, we are talking about 3 months, and here 9 months. So therefore, this period is the pre-acquisition, and this is the post-acquisition period. Okay, so here we can say post-acquisition period, only for 3 months. Now, at the time of acquisition, you are given the consideration, the fair value of the consideration, 9.5 million, and the acquisition percentage is 75%. So therefore, the group structure is very clear. So now, usually what you have to do is, you need to identify, there are 5 steps that you need to follow in order to prepare the consolidated financial position. First one is the identify the structure, the group structure. What is the structure? Structure, you know, P has acquired S 75%. So therefore, there is non-controlling interest of 25%. Okay. Then, secondly, what you need to do is, you need to identify the net assets of the S company, subsidiary company, at acquisition date as well as at the reporting date. This is very important to identify. Now, when you analyze this, okay, now you are given at the reporting date, this is the 31st March 2016 reporting date, share capital is given and return earnings also given. Okay, the total net assets 7,000. So you can identify, if you look at this, so let's identify the net assets at acquisition and at the reporting days, at reporting. So this is 1st January 2016 and this is 31st March 2016. So you have share capital and retained earnings. Okay, so how much is the retained earnings? Its share capital is 5.5 million and return earnings are 1,500. 1.5 million and 5.5 million. Okay, so let's identify this. 5.5 million and 1.5 million return earnings. So this is the total net assets 7,000. Okay, now you need to identify at the time of acquisition what will be the net assets. So from the acquisition date to the reporting date there shouldn't be any change in the share capital. Okay, so since P has acquired S 75%, since acquisition date to the reporting date there shouldn't be any change in the share capital or the share premium. So plus the share premium. So therefore there won't be any changes in the share capital. For the retained earnings, you are given the retained earnings. You can see the retained earning at acquisition. The fair value of the land owned by Sam exceeded its cost by 1.2 million. This land was still owned at 31st March 2016. So this is fair value of the net assets. For the fair value of net assets calculation, you need to consider this, the revaluation of the land. During the post acquisition period, Sam sold goods to Park $600,000 on which it earned a margin of 15%. 70% of the goods remain in Park's inventory at the year end. So here we need to calculate the unrealized profit, that I will do it later. The fair value of the non-controlling interest in Sam at the date of acquisition was 2.8 million. So this is also required to calculate the goodwill as well as non-controlling interest. We need to identify the retained profit of non-controlling interest. For the year ended 31st March 2006, Sam made a profit after tax of 300,000. Now, if you look at this profit for the year ended 31st March 2016, for the year ended means this is for 12 months period, they have earned a profit of 300,000. Okay, whereas if you look at the total profit 1.5 million. Okay, to identify the retained earnings at acquisition, what you should do is, now this is at reporting date 1.5 million. So what you should do is, now you are given, since for the year ended 31st March 2016, Sam made a profit of 300,000. Okay, this 300,000 is earned from 1st April 2015 until 31st March 2016. So this is for 12 months period. So this company was acquired on 1st January. So therefore this 300,000, if you divide by 12 times 3, so that will be this portion. This is 1st January 2016 for 3 months period, and this is for 9 months period. So 3 months period, that's going to be how much? 300,000 divided by 12 times 3, it will be 75,000, and here 225,000 for 9 months period, and this is for 3 months period, 75,000. So therefore, in order to identify the return earnings at acquisition on this particular date, what you should do is, from 1,500 you need to deduct less 75,000. So that will be 1,425,000. So therefore your total net assets is going to be 6,925. 6,925. So this is the net assets at acquisition, and at the reporting date it's going to be 7,000. Okay, so first of all you need to identify that net assets. Then in addition to that, you are given at acquisition the fair value of the land owned by Sam exceeded its cost by 1.2 million. This land was still owned at 31st March 2016. So therefore you look at this, your total net assets, share capital and retained earnings 6,925,000. All these numbers are in millions. So to that you need to add the fair value of the fair value adjustment for land. How much? 1,200,000. So if you add 6,925,000 plus 1.2 million, that amount will be how much? 6,925,000 plus 1,200,000. It's going to be 8,125,000. This is going to be the net assets at the time of acquisition, because you need to do the fair value adjustment to the net asset. So this will be the total net asset. Okay. So now we identify, as I told you, the second step is to identify the net assets at the time of acquisition as well as at the time of reporting date. That we already identified, which is going to be how much? At the time of acquisition, 8,125,000 after fair value adjustment, and 7 million at the reporting date is given in the balance sheet. Now, what is required here? Now, let's go to the questions. Select the formula that correctly calculates Sam's return earnings at the date of acquisition. This is Sam's return earnings at the date of acquisition. So which is going to be how much? Now that already I calculated Sam's return earnings at the date of acquisition. That we already calculated here, which is 1,425,000 return earnings at the time of acquisition. What we did from the reporting date return earnings, we deducted 75,000, which is the post profit. So therefore, if you go back to the formula, what did I do? 1.5 million minus 75 to arrive at this figure. So how did I got this number 75,000? You are given the return, the net profit earned for the period for the year ended 31st March 2016 as 300,000, which I divided by 12 to arrive at 3 months post profit. That post profit I deducted to arrive at acquisition return earnings. So if you look at the formula, you need to deduct from 1.5 million this 75,000. Okay. So if you look at this formula, you are given this first one is 7,000, which is not at all correct. Then this is not correct. So answer should be either this or this. So eventually you should get 1,425,000. Okay. So here 1.5 million minus 300. Okay. But we had to deduct the post profit to arrive at the pre. Okay. From 1.5 million you need to deduct the post profit to arrive at the pre acquisition retained earnings. Okay. So 300,000, to that they have added 9 months profit. So minus 300 plus, of which they have taken 12 months divided by 12 times 9, which is 9 months profit they have taken, which is going to be 225. So therefore the net impact is minus 75. I think 1,500 minus 75 will be 1,425,000. So therefore I think this should be the correct answer. Let's see, look at this. 1,500 minus 300 plus 3 months profit is added. Now if you take that minus 300 plus 3 months profit, that will be minus 225. Then from 1,500, if you deduct 225, you will not get 1,425,000. So therefore what you should do is from 1.5 million, you should deduct the total of 75,000 that you can derive from this formula. So therefore the correct answer is this, the second one. Okay. So this is the Sam's return earnings at the date of acquisition. Now the second part, select the formula that correctly calculates the fair value of net assets of SAM at the date of acquisition. Okay. Now, fair value of net assets, that also we calculated in our second step, which is we took share capital 5.5 million, return earnings of 1,425,000 plus the fair value adjustment of 1.2 million. Okay, but when you take this, you deducted from the reporting date return earnings the post profit for 3 months. That's how you arrive at this number. Okay, so let's look at the answers. You are given 3 answers. You have to start with 5.5 million. Okay, this is 5.5 million is correct. Then what you need to do is you need to add the retained earnings. Return earnings has to be added and the fair value has to be added. So it looks like now this particular the first question, the first answer is not correct because the first answer is not correct. If you look at 5.5 million, straight away they are adding 1.5 million. This is the total return earnings at the reporting date. So therefore you can't take the entire profit. So we are calculating, we need to calculate net fair value of the net assets at the date of acquisition. Okay, so therefore this is a post the return earnings at the reporting date. You can't take this. Therefore this answer is not correct. Then out of second answer and the third one, we have to choose the correct one. Now since you are adding, you have to add to the share capital, the retained earnings has to be added. So here they have deducted. So therefore this is not the correct answer. The right answer should be this. Let's look at this. 5.5 million plus 1,500 minus, okay, so if you take this 300 divided by 12 times 3 is going to be 75. Okay, this is what we need to deduct, the post profit from the reporting date return earnings. So 1.5 million minus 75, this is the correct answer, 1,425,000 plus the fair value adjustment. Okay, so eventually you should get how much? Eventually you should get 8,125,000. Okay, so this is the correct answer. Eventually 8,125,000 is the correct answer. So therefore this is the correct answer. Okay, now third one. Select the formula that correctly calculates the goodwill at acquisition. Okay, now the third step. Now the first step is to identify the structure, then to identify the net assets. So first and the second question are from the net asset part. Now the third step is to identify the goodwill. Third step is to identify the goodwill. How do you calculate the goodwill? So goodwill, to calculate goodwill, you should consider consideration, fair value of the consideration paid. To that you need to add the NCI, the fair value of non-controlling interest. Okay, so consideration paid, the fair value of the NCI minus fair value of the net assets at the acquisition date. From this total, if you deduct this, that's going to be your goodwill. Okay, now let's go through the question again. Now we need to identify the fair value of the consideration paid, which is going to be how much? The park acquired 75% of the issued share capital of SAM on 1st January 2016, 9.5 million. So therefore the fair value of the consideration is 9.5 million. So the fair value of consideration 9.5 million. To that you need to add back the fair value of NCI. So fair value of NCI is also given. How much is that? The fair value of the non-controlling interest in SAMS at the date of acquisition, 2.8 million. Okay, so 2.8 million is given here, 2.8 million. To that 2.8 million, you need to deduct the fair value of net assets. Okay, the fair value of the net assets is, in the second question we calculated fair value of net assets of SAM at the time of acquisition, which is going to be 8,125,000. So once you deduct 8,125,000, that's going to be your goodwill. So goodwill will be 12,300,000 minus 8,125, which is going to be 4,175. But this is not the way you need to answer this question. You are given three formulas. You need to choose the correct one, okay, to calculate the goodwill at acquisition. So basically what you need to do, fair value consideration 9.5 million plus 2.8 million. So I think the first answer is not correct. And out of second and third, we need to see how much is the fair value consideration paid. Then 2.8 million is the fair value of non-controlling interest, and the total net assets 8.125. Okay, so therefore the correct answer is the second one.